In the mutual fund corner, waiting to answer all your mutual fund related queries with an expert. Meanwhile, for the markets, we're at the high point of the day for the Nifty as well as the Sensex, and the Nifty is actually led higher by the banks. So the banking index should come up for you, which is higher by close to around 260 points for the Nifty Bank. The mid-cap index too picking up some steam on an index level, outperforming with a gain of about 0.8%, and the broader markets as well. Market breadth split right down the middle, almost the same number of stocks which are in the red as there are in the green, and that is a positive for our markets given the fact that over the last 12 trading sessions there have been a lot of stocks declining as against the stocks which are advancing. We will take a look at all the top stories and then hand it over to Sumera. Steady day of gains on the Dalal Street as the key indices inch up over 0.6% in terms of a gain. Mid-caps gain are in line, mildly outperforming. In a mega CNBC TV 18 exclusive, India Bulls Housing Finance Management clarifies that wholesale book will not have material impact on its FY20 profits, says it has zero exposure as on date to the Anil Ambani Group, Lodha Group, and has never done business with DHFL. Beaten down stocks reversed losses today. Reliance Group stocks like Reliance Capital, Reliance Power, Reliance Infra as well, and Yes Bank, Chen Irrigation, Jet Airways, all of them rally after a week full of falling. UPL continues to decline for a second consecutive day. HSBC says trade tensions and African swine fever could actually be headwinds for soybean. However, they do not expect a near-term impact on the company. Sun Pharma is among the top Nifty gainers. The company's Halol plant gets 4 observations from the US regulator. The stock upbeat after JP Morgan says the observations look resolvable and they won't be a hurdle for future approvals. With that, we hand it over to Sumera, who is with Kaustubh Belapurkar.
Mangalam, thanks very much for that. So Morningstar India's Kaustubh Belapurkar joins me this afternoon. Kaustubh, hi, good to see you again.
Hi, Sumera.
And normally we would answer the queries that our viewers send in, but there are a lot of queries which are spread over so many people that I'm going to collectively address them. But before I do that, I want to just take you through what has happened. So earlier this week, HDFC AMC has introduced a liquidity arrangement for certain fixed maturity plans which were impacted by the exposure to the SL Group. Now, this breather is for the FMPs which have either already matured or they are due for maturity right up to September end, which is when the mutual fund lenders' standstill agreement with the SL Group will come to an end. So what exactly is this arrangement, right? So HDFC AMC will buy out the residual portion of the non-convertible debentures of SL Group on which monies have not been paid to the unit holders. So the pending portion, which was earlier withheld, will now be paid back to investors. The maximum amount allocated is 500 crores, which is enough to roughly cover all the schemes which have been impacted. Now, Morningstar India estimates that investors in a total of about 11 FMPs odd with exposure to SL Group are set to benefit. Now, a lot has been said for and against this move. The most important argument in favor being that it is the fiduciary responsibility of an asset management company to protect the interests of their investors, and that past instances have set a precedent for unusual circumstances like this as well. You'd recall a similar arrangement organized by Franklin Templeton in 2016 with respect to their exposure to JSPL as well. Aditya Birla Sun Life had used this lifeline in 2009 when Wockhardt was on shaky ground. Now, the argument against this move by HDFC AMC says that these liquidity arrangements disrupt the notion that mutual funds are a pass-through vehicle where risk and reward should reflect in equal measure to the investor. And of course, the more forceful one being that shareholders have been left to bear the brunt. On this last point, I want to actually just read out clause 17 of HDFC AMC's red herring prospectus, which says, and I quote, "We are required to prioritize the interests of our customers, which could conflict with the interests of our shareholders in terms of the SEBI mutual fund regulations. We are required to avoid conflicts of interest in managing the affairs of our mutual fund schemes and keep the interests of our customers paramount in all matters." Now, not to confuse that I'm not speaking on their behalf, but this is just to sort of put to rest this whole argument of, should they have given the preference to their customers, which is the unit holders, or their shareholders. But, I don't want to get sidetracked into that debate because the purview of our show is, of course, the mutual fund investors themselves. Now, cost of the FMP investors, or for that matter, any investor impacted by this whole standstill agreement, didn't ask for the standstill agreement in the first place. Therefore, do you think HDFC AMC has discharged their fiduciary responsibility to their unit holders?
Okay, so I'll answer this question in two parts. If you ask me specifically about this particular instance, I think it's been an exceptional circumstance, and I'll explain why. So in that regards, what they've done is probably the right path to go. And the reasons for that are simply, because we had a standstill agreement in place, and I think what got missed was actually a very clear communication proactively to investors that this is something we're seeking to do, and you probably will not get a payout, because FMP investors, when they come in, they would think that, okay, my money's going to come in at XYZ date. So there's no proactive communication. If that happens, then somewhere you're left that high and dry, that this is something that I thought would come through to me but didn't, right? So in that sense, because they've addressed that sort of concern, specifically for those FMPs that either matured or going to mature till the standstill agreement is in place, I think that's a very good move, because sentimentally, it takes care of something that ideally should have probably been done proactively, at least in terms of communicating. So that's I think that's good. But the other side, if I look at it, is that one is that, does it set a precedent? I mean, I hope not, because I think that's something, while you want to do right by the investors, you don't want to set the wrong sort of expectation. So this, like I said, it's a very, very exceptional circumstance to my mind, and it shouldn't become the norm in terms of, going forward, that an investor expects that something goes wrong with a bond or any other asset, then, you will be bailed out, because that's not really what an asset manager should be doing on an ongoing basis. Exceptional circumstances, I think that's pretty fair.
Okay, the other argument, Kaustubh, and what you point to is that expectations might get raised, right? And which would be the case for other investors of HDFC AMC in their open-ended schemes, as well other AMCs themselves. Do you think more people may follow this route? Do you think they should have followed this route?
So I think what, it's very hard to see what, obviously the expectations are definitely now, as if I'm an open-ended investor who's, who's obviously been hearing and reading all of this news, would say that, hey, what about me, right?
Yeah.
I mean, why am I not probably, why is this arrangement not for me? But like I said, that because the expectation of what was there, with, the nature of the product, and there was no communication around that. That's probably more importantly why something like this had to be done. So obviously there would be questions, but I don't think it should be, like I said, to the point that it shouldn't become the norm. So I wouldn't expect at least for the open-ended funds for this something like this to follow. If other AMCs do it now, that's something obviously I can't speak for them, but yes, I'm sure they'll be facing a lot of investor questions, who have those FMPs that what about us? And it's a little bit of a tricky situation.
Yeah, I know. It's a grey area, right? And to each his own in terms of how they want to navigate it. Now, there's this particular bit in this arrangement which says talks about the valuation, right, at which the monies would be paid back. Now, the way I understand it is that, at the date of maturity of each individual FMP, the perceived valuation as on that date would be taken into account. Right. So this would naturally mean that there would be some bit of a haircut still for investors. Yes,
I would think so. And again, we're also trying to get more clarity around that, because clearly, it says valuation on that particular date or the redemption date. And if you see what's happened to the bonds, the two particular bonds, Edison's and Sprit, that, they've been downgraded. They were an A+ rated security at the start of the year, and now they're a BBB. They've gone through a couple of downgrades as recently as 23rd of May. So obviously, given common logic, there will be a haircut that will be applied at which, HDFC would be acquiring these bonds.
So therefore, some pass-through is there, right? It's not to say that it's a complete bailout, kind of like, somebody compared it to a farm loan waiver when spoil the credit deficit, etc., etc. But there is some effect of pass-through as yet, because FMP by its very nature was sold as an alternative to FDs. I suppose a little bit of a surety is not going to be too bad. But going forward, Kaustubh, this whole animal that is FMP, right? Do you think it's going to lose some bit of sheen with at least the retail crowd?
So I think that's already kind of happened slightly,
Because, when the first of these FMPs came out, we were already past the FMP season. Right? So, even if we see a tad bit of impact now, I don't know how far it'll go to actually suggest what happens, say, early next year.
Yeah, so I think FMPs still do play a certain role. but investors sentimentally would have obviously taken the impact of all the sort of news. But I think even the regulators been pushing for this, and that you can't indicate yields. You can only talk about an indicative portfolio, which is but it's all about setting that expectation, right? Because you can't be pitching it as a pure FD play. You have to
exactly
make the risks clear. All the intermediaries in this process that look, it is a fixed maturity plan, all right, but there are risks inherent in this process that you don't know what yield you're going to get. There could be potential credit environments kind of playing out. So I think that clearly needs to be explained properly to the investor. It's all, I mean, all of that comes in a bulky sort of offer document, but finally the intermediaries need to kind of the messaging needs to be very clear to the end investor.
Yeah, actually the big lesson out of this that I would imagine for the industry is that the RMs or the relationship managers, which are the last point or the first point of contact rather with the customer base, needs to be better educated, and the spirit of the fund or the investment needs to be conveyed more conclusively. Okay, we'll take a very quick break. There are some queries that we'll need to answer, so we'll do that when we return. Do stay on with us.